You did everything right. You saved for 40 years. You never overspent. You didn't touch your IRA a day before you had to. And then you turn 73, and the IRS sends you a bill anyway. Not because you spent more. Not because you bought a boat. Just because of one number, your age. It's called a required minimum distribution, an RMD, and it's not optional. The government forces you to pull money out of your retirement account every year starting at 73, whether you need it, want it, or not. And that forced withdrawal can quietly push you into a higher tax bracket and a higher Medicare premium in the very same year, without you changing a single thing about how you live. I'm Ray. Today I'll walk you through exactly how this works, the trap hiding in your very first RMD year, and one completely legal way to soften the hit. Quick and important. I'm not a CPA, attorney, or financial advisor. This is education, not tax advice. RMD ages, limits, and Medicare thresholds get adjusted over time, so always check the current numbers at irs.gov and medicare.gov, and loop in a licensed professional for your own situation. So what exactly is an RMD? If you have a traditional IRA, 401k, or similar retirement account, the money in there has never been taxed. The IRS let it grow tax-deferred for decades, but it doesn't let you keep it tax-deferred forever. Starting at age 73, the law requires you to withdraw a minimum amount every single year, calculated by dividing your account balance by a life expectancy number the IRS publishes. That withdrawal counts as ordinary taxable income, same as a paycheck, whether you spend it or just move it into a regular savings account. One important exception: Roth IRAs don't have this requirement during your lifetime. This whole topic is specifically about traditional pre-tax retirement accounts. One small practical relief. If you have more than one traditional IRA, you calculate the RMD for each one separately, but you're allowed to withdraw the combined total from just one of them, instead of pulling a little out of every account. 401k plans generally don't get that same flexibility. Each one is handled on its own. Risk number one, and it catches people in the very first year: the double-RMD trap. In the year you turn 73, you get a choice. Take your first RMD by December 31st of that year, or delay it, but only until April 1st of the following year. Sounds like a nice grace period, right? Here's the catch. Your second RMD for the following year is still due by December 31st of that same following year, no matter what. So if you delay that first one, you can end up taking 2 full RMDs in the same calendar year. Let me show you what that actually looks like with real numbers. Say you have $500,000 in a traditional IRA. At 73, the IRS divides that by a life expectancy factor of 26.5. Your first RMD is about $18,868. Delay it, and by the end of the next year you also owe your second RMD, now divided by a factor of 25.5, about $19,608. Add those together, and you're reporting almost $38,500 in withdrawals on a single tax return, nearly double what a normal year looks like. That's a real, current table example, not a worst-case scare number. 2 withdrawals worth of taxable income landing in a single year can push you into a noticeably higher tax bracket, and that's before we even get to Medicare. Risk number 2. That forced income can trip something called IRMAA, a Medicare premium surcharge for higher earners. We did a full video on IRMAA and how it works for surviving spouses. Same mechanism applies here, just a different trigger. For 2026, the surcharge starts kicking in once your income crosses roughly $109,000 for a single filer, or about $218,000 for a married couple. An RMD, especially a doubled one in your first year, can push your income over that line even if absolutely nothing else in your life changed. And remember, Medicare looks at your income from 2 years earlier to set this year's premium. So an RMD surprise today can show up on your Medicare bill 2 years from now. Risk number 3. What happens if you just don't take it? This isn't a maybe later kind of requirement. If you miss your RMD or take less than required, the IRS charges an excise tax of 25% of the amount you should have withdrawn. Fix the mistake within 2 years, and that penalty can drop to 10%. Better than it used to be, but still real money lost for a paperwork mistake. Here's a piece of good news though. If you missed it for a genuine reason, illness, bad advice from an advisor, a bank's paperwork error, The IRS allows you to request a waiver using Form 5329, attaching a short letter explaining what happened. It's not automatic, and the IRS reviews every request, but it's a real, legal option people don't know exists. So, forced withdrawal, possible bracket jump, possible IRMAA jump, and a real penalty if you skip it, with at least one legitimate way to ask for mercy. Is there anything you can do before any of this happens? Yes, one strategy worth knowing. It's called a Qualified Charitable Distribution, a QCD. If you're 70 and a half or older, note, that's even before RMDs start. You can send money directly from your IRA straight to a qualified charity. For 2026, you can do this with up to around $111,000 per person, $222,000 for a couple. Here's why it matters. A QCD counts towards satisfying your RMD requirement, but it does not count as taxable income. Say your RMD is $60,000, and you send $40,000 of it directly to charity as a QCD, then take the remaining $20,000 yourself. Only that $20,000 shows up as taxable income, not the full $60,000. That can be the difference between staying under the IRMAA line or going over it. For people who already give to charity anyway, it's close to a free strategy. One common mistake worth flagging. The money has to move directly from your IRA custodian to the charity. If you withdraw it yourself first and then write a check, it no longer counts as a QCD. It's just a regular withdrawal followed by a regular donation, and you lose the tax benefit entirely. Your IRA custodian can usually set this up for you in a few minutes on the phone. If charitable giving isn't part of your life, there are other strategies, like Roth conversions in earlier, lower income years. But those involve real tax trade-offs and belong in a conversation with a CPA, not a YouTube video. Richard turned 73 this spring. Martha is a few years behind him. Neither of them had ever taken a dollar out of Richard's old 401k. It had just been sitting there, growing, for over a decade. When the RMD notice came in the mail, Richard almost set it aside. It looked like just another account statement. Martha caught it and actually read it. They sat down and ran the numbers with their CPA. Taking the full RMD as cash would have bumped them right up near that IRMAA line for the first time in their lives. Richard already gave to his church and a local veterans charity every year anyway, so his CPA suggested directing part of his RMD there as a QCD instead of writing a separate check from his bank account. Same generosity Richard already planned on, just structured a little smarter. Richard says it didn't feel like a financial trick. It just felt like doing what he was already doing, the smart way. 5 steps. Most of them are about timing, not money. Step 1. Find out your exact RMD age and first deadline. Don't guess. Your account custodian, the company holding your IRA or 401k, can usually tell you the exact number. Step 2. Decide your first-year timing carefully. If delaying to April 1st means doubling up that year, run the math with a CPA before you default into it. Step 3. Mark your calendar every year. December 31st doesn't move, and the penalty for missing it is real. Step 4. If you already give to charity, ask about a QCD before you take your RMD as cash. It's one of the few free tax moves left in the code. Step 5. Review your traditional versus Roth mix with a CPA well before 73. Sometimes smaller, earlier moves can shrink the size of this problem years in advance. None of this is about avoiding your responsibility. It's about not handing the IRS a single extra dollar more than the law actually requires. If this helped you see something you hadn't thought about, hit subscribe. I break down a retirement money topic every week. Tell me in the comments, did your first RMD year catch you off guard, or did you see it coming? Next time, we're staying right here on this thread. The legal loophole that lets some retirees move money into a Roth account and pay 0% tax doing it. It connects directly to everything we just talked about. Don't miss it. I'm Ray. Take care of your money and take care of each other. See you in the next one.